Hi, and welcome to Hedge Fund Manager. I'm, as always, Karl-Mikael, and we're continuing the Apple deep dive. And now we're in the meat of things with the P equals F times V fundamental value analysis of Apple. And I can't stress this enough. Whenever you look at a company and its stock and are trying to assess whether it might be a good investment or not, I urge you to always start with a very clear P equals F times V analysis. So what you do is you analyze and extrapolate the fundamentals. You can choose which fundamentals you want, for example, sales, earnings, assets, number of employees, or total investments, or even costs. You can analyze whatever fundamental you want and its associated valuation multiple. But just make sure you use a relevant fundamental, the actual value driver for a company. And the most useful value drivers are what the operations are actually about. So it's typically sales and earnings, and possibly also net assets, or what we call book equity, or just book. And the associated valuation multiples, which we should always also analyze and extrapolate, so the associated valuation multiples are to sales, it's price sales, or actually enterprise value to sales, to make sure we take debt into account. But we only need to take the net debt into account if they actually have a decent sized either negative net debt or positive net debt. Otherwise, we can typically simplify our analysis by going straight to price sales or price earnings rather than EV to sales and EV to EBIT. But those are just details, and you are always free to use the accounting details in order to make a slightly better analysis. What the P equals F times V method is about is that it's the overarching method of using fundamentals with as good forecasts as you can make and the associated valuation multiple, be it based on cash flows or earnings or sales or assets. And those are the most important ones, the only ones you typically would ever need, really. So after forecasting fundamentals based on their historical trends and patterns and accelerations and decelerations, then you forecast a reasonable and plausible valuation multiple in the future. And remember, valuation multiples, they should not be trending. There are rather levels that they stay at, or ranges that they stay within, or warranted levels given a certain set of assumptions for the future. For example, you can use a DCF calculator online, and you can input forecast growth rates, profit margins, end state multiples, etc. And what you get out of the DCF calculator is a warranted valuation multiple today, given those sets of assumptions. And as I always say, the average historical level for the market is about 15, 16, 17 times EPS, and that when bought at that level and when sold at that level in the future, what you have gotten is a 10% total annual return from your investment, and that is the average market multiple and the historical average total return. And you can always use that as your benchmark for what an average company should be valued at. And then on top of that, we need to take into account a higher risk level or a higher required rate of return in order to assume that risk. But again, The P equals F times V method always start by very clearly stating what fundamentals you're using and what the forecast is and why you make that forecast. And the valuation multiples, which one you use, why you use it, and how you forecast it, and why that is a reasonable, warranted, plausible, likely multiple. Then you forecast the future price using F times V, and finally calculate the CAGR. So let's look at Apple specifics. The revenue growth has been just about 5% the last 10 quarters. That's pretty bad. It's not even certain Apple can grow in line with the average economy. The gross profit margin has increased recently. That's pretty good, and that is helping the EPS growth and the profit growth. But it could be putting pressure on Apple's ecosystem. Could be worth checking further on their DSOs and DPOs to see if they are pressuring their clients or their suppliers. It can also be just simply difficult to sustain such high margins, but as we can see here, Apple's margins actually aren't that high compared to the top 15 companies. Now going straight to EPS growth rate. That one is better than their sales growth, both due to higher margins and also buybacks. But as we can tell, they are pretty cyclical, sometimes with bursts of growth due to new products, and sometimes periods with negative growth. And here we can see they have had a really lousy EPS growth rate for quite some time, at least comparatively. But looking at more detailed numbers here from Koifin, you can see that the actual EPS growth rate has been around between 5 and 15% each quarter on year-on-year basis. Maybe we can see a pattern here that a previous weak quarter is met by a previous high growth quarter and vice versa. So the average here is actually pretty unimpressive. Here we see the EPS, actual EPS level for many quarters, and they seem pretty stagnant. I also check FxV, free cash flow per share for Apple using Koifin, and at least it's good to see that the EPS it actually translates into actual cash flow. However, the overall arching picture is one of weak growth, almost turning downward, as you can see. And remember, this is a $200 stock, and they're hovering around a $6 EPS or free cash flow. Just look at these annual numbers, just staying stuck here at $6 per share. Free cash flow per share is a little bit more. You need more detail to go into exactly why it's sometimes higher, sometimes lower than their earnings. So the questions here are: can Apple revive its growth? Can they grow faster than 5% in terms of sales, and at a 5 to 10 or 10% level in terms of earnings per share? I think we should check with analysts. We should check with the company guidance, with the macro environment, and your own intuition for their products. I mean, can they come up with new product categories and make new growth bursts, or have they exhausted the wallet share of clients? I mean, is there room for such a big company as Apple? Can they grow? Can they grow even bigger, and can they grow faster than the economy at this point? We'll look at what analysts are saying. They are projecting 2 to 6% annual growth, and I would say they are typically a pretty optimistic bunch. And their EPS growth is 6, 7 to 10% EPS growth. I think this is also probably pretty optimistic. I foresee a tough macro period ahead, and Apple could actually grow slower than average. And my intuition tells me that this could be a 3% sales growth and perhaps a 5% EPS growth company. So what is then the warranted valuation multiple at this low growth? Well, let's look at that after this.